there's a bit of a worry when it comes to the capital allocation, or if I can say the balance sheet and debt levels at CCL Products as well. So let's try and decode that with Mr. Praveen Jaipuriar, the Group CEO, joining us on the show now. Praveen, hi, thank you so much for making time and speaking with us. Well, the statement that you made that, the debt from the current 900 crores can go up to around 2,000 crore rupees, surprise the street a tad bit. Clarify to us of what the game plan is and what would be the sustainable debt level.
Good afternoon, everyone. Okay, let me just kind of clarify on the debt level thing. So actually, the 2,000 crore number is actually for outer limit that one had stated from our side. Because a lot of our working capital debt depends on the coffee prices, and if you would have noticed, the coffee prices have been at all-time high. But our estimation is that generally this is the outer limit, and we end up utilizing around 70 to 75%. So realistically speaking, the debt levels will be close to 1,400 this year. So that is the clarification we had, put in the market, because a lot of people had interpreted that the debt levels could be at 2,000 levels, but that's not the case. That's an outer limit that we had taken sanction for. But generally, the utilization will be at 70-75% level.
Mm-hmm. Praveen, what was the reason for your margins coming under pressure this time? They've come down to 16%. It is temporary, or will it revert back to above 17?
So, the margins actually, it's a little optical in nature. I'll explain you why. Because when the coffee prices go up, we also get advantage of the increased coffee prices. So what happens is that while our volume growths were around 18 to 20%, if you were to see the value growth that we got in Q1 was 28%, which means almost 10% or so advantage was there because of the coffee prices. So generally when we, the opposite will happen when the coffee prices come down. So what we ask, analysts and other people to decode our P&L as follows. We generally say that our EBITDA growth will be in line with our volume growth. So if you see our EBITDA growth is at 20%, which is perfectly in line with the volume growth. And therefore, in our model, which is a cost plus model, we generally look at the fact that whether we are earning, per ton, the same EBITDA levels or not. So that is completely intact. It is more optical in nature. And when the coffee prices soften, you will see that it automatically will start climbing up as well.
Sure. So just on that volume growth itself, you're saying you're clocking around 20%, but going forward, given the fact you have aggressive Capex plans also lined up, do you expect the volume growth to pick up materially from here on?
Yeah, not really to pick up. Actually, if you see last year, we had given a guidance that for the next 4 years, at an annual level, we are looking to grow at 18-20%, which meant that, this is the kind of Capex that was required to fulfill our growth ambition of 18-20%. And that's the reason Capex were put in. It's not the, other way around. So, if you see our growth trajectory, we are expecting that we will grow at similar levels. And these Capex that we have put is actually, fulfill our growth momentum for the next 2 to 3 years.
Mm-hmm. So this visibility of 18 to 20% growth for the next 4 years, where is this coming from? Basically, I want to understand, most of the management we speak here are unable to see beyond 12 months, which is 3-4 quarters at max. And you are sounding so confident and comfortable about 4 years of 18-20% visibility. This is strange.
So if you see now, if you would have tracked our, business model, generally we say that almost for the next 3 to 6 months, we have complete visibility because we have order in hand. And we have almost 60 to 75% visibility for the year going forward. And for some of the cases, for example, if you look at our freeze dried, we are almost booked for next 1.5 years, which means that we have a very high visibility of things coming our way in the future. And having said so, what I would like to mention here is that in spite of the fact that we are one of the largest players in the B2B market, we are still very small share. We are almost 8% of the addressable B2B market, 7 to 8% by our estimates. And we feel that there is ample room to grow because of a couple of things. One is that, if you see, because of our volumes, we have a certain competitive edge in terms of, getting the economies of scale. which helps us, be competitive in the market. Secondly, the kind of R&D that we have had for the last 25 years, and the kind of equipment that we have had for last so many years,
Sure.
helps us deliver that kind of product profile which the consumers want, customers want.
Sure.
So all these things put together, gives us that confidence that we'll be able to drive these kind of growths.
Okay, so very confident about the future growth, have a lot of visibility. Thank you, Praveen, for joining us with that quick take. But time now to slip